Hello and welcome to a CMS Forex Daily Market Recap. I'm your fundamental market analyst, Nick Nassad. Today is Wednesday, May 26, 2010. Let's start by taking a look at the euro-dollar pair, which we see declined during overnight trading and then extended its losses during the New York session until we reached the area around 1.2190. Yesterday's high around 1.2386 matched up rather nicely with our 200 period moving average in our 1 hour time frame, and we did use that as resistance just as we entered the Asian session. The events in Spain, which was the takeover of a regional bank over the weekend and then the consolidation of 4 other saving banks into one financial institution, put the focus on the Eurozone banking system. What was a sovereign debt situation could now spill over into a banking crisis. One main indicator points to banks becoming more risk averse. Interbank dollar lending rates marched to a new 10-month high as banks are cautious to lend each other as exposure to debt increases counterparty risk. The fear is that sovereign debt crisis will damage the balance sheets of banks with significant exposure to peripheral Eurozone countries, and those bad debts will rack up as the economic growth slows, which is prompting other banks to refrain from lending to each other. A reduction in lending would further add strain on economic growth in the region, and therefore the euro remains under pressure as it comes close to testing its lows from yesterday. And again, we have the 1.2150 area as our overall underlying support, which was our four-year low for the pair. Similar to my comments yesterday, right now there's just not that much momentum for the euro to rise, and with a lot of risk in the system, any news could send the euro lower. We came into this week with the news about the Spanish banking sector, and that continues to pressure the euro. Now look at our other main European currency. Here we're taking a look at the pound-dollar pair, and we see that we had actually rather tight range in today's trading, and we're ending up towards the higher part of the range today at 1.4445 at the filming of this video around 2:30 p.m. Eastern. So we remain confined within this sideways range that we showed in our previous broadcast. Now, if we go ahead and take a look at the euro against the pound, we see a strong move in favor of the pound in today's trading as we broke below the 0.85 area in today's session, which was our support from last week. The rally in the euro that we saw late last week has now completely been pared down, and now we actually fall below our lows from last week. So now we do test our lows from May 6th and May 12th, and that'll be our next levels of support for the pair. While the euro was down on the day, there wasn't the same sense of risk aversion in other currency pairs. For instance, commodity currencies, which were much maligned last week, rose overnight, extending the gains they had seen in the late New York trading from yesterday's session. The Aussie, here we're taking a look at the Aussie US dollar pair, and we see that the Aussie extended its gains and actually moved above the 83.50 level for a very brief time at the beginning of New York trading to set a high at 83.87. However, the market did seem to reject that move higher, and we trade around 82.80 right now at 2:30 p.m. A press release was put out saying that Australia may scale back the tax that they want to impose on mining companies, which gave the Aussie a boost, and actually is part of the reason we did have this candle here where we jumped above 83.50. Now you could take one positive away is that we moved above our short-term and medium moving averages, but as we can see, we're not able to sustain this move above our horizontal level of resistance at the 83.50 level. U.S. equities did open stronger with the Dow up in triple digits early on, but we have seen stocks pair their gains in the New York afternoon. Still, oil prices were up a sharp 4.2%, and gold prices were up as well. With U.S. equities higher and oil up as well, the U.S. dollar Canadian dollar pair moved in favor of the loonie, testing the area below 1.06 briefly in New York trading, but trading around 1.0627 during the time of this video. Here too, we broke below our 100 period moving average on the 1 hour time frame, which had been our support earlier this week. If this pair continues to move lower in favor of the Canadian dollar, our next level of support comes at 1.0550, which was our support on Monday's session. Also, our 200 period moving average lines up rather nicely with an upward sloping trend line if we connect our lows from May 13th and May 18th. So we have some levels of support coming up for this pair if we continue to see risk appetite and which would favor the Canadian dollar. However, we have seen these near-term relief rallies turn rather quickly as soon as there are any kind of new news coming out about systemic risk in the financial markets. So with concern about risk in the system still high and interbank lending rates rising, we did have some positive data from the US, so that helped in today's trading, but I don't know if it'll be enough to turn the tide of the current sentiment. Right now, fear about the Eurozone sovereign debt crisis turning into a banking crisis will continue to have the markets on edge. Now, I did mention a couple of US releases, so let's take a look at those. New home sales surged 14.8% in April to an annual pace of 504,000 units, the strongest sales pace since May of 2008. The sharp increase, the second one in a row, comes as demand rises as buyers try to cash in on the government's $8,000 tax credit before it expired. While we still see low mortgage rates and low prices in the housing market, the end of the tax credit could mean that we may see a loss of a supporting factor here. Inventories, meanwhile, did fall 7% in April to an estimated 211,000 homes, which would put the inventory to sales ratio to 5.0 from a revised 6.2 in March. So we'll see if this is a last hurrah for home sales or if we're able to maintain some momentum even though the sales pace will undoubtedly fall after the expiration of the tax credit. A second report, durable goods orders for the month of April rose 2.9%, which surprised forecasts on the upside following an upwardly revised flat reading in March. The headline number was skewed somewhat as orders for non-defense aircraft and parts surged 228% during the month. So that pushed up the overall headline figure. If we excluded the 16.1% increase in the transportation sector, orders actually fell 1%, though we did have some positive readings from the communication equipment. Shipments rose 1.4%, while inventories were up 0.7%. An important gauge of company investment, which is capital goods excluding aircraft, fell 2.4%, which is a slightly negative sign, as we had some strong momentum in capital spending by U.S. businesses in the previous 2 months. Still, it's a positive sign for the U.S. manufacturing sector that we did have a strong 2.9% increase overall. Combined, the two pieces of data are positive for the U.S. economy, and the data highlights the thinking that the U.S. economy is in better shape than those in the Eurozone and Japan, and therefore will be more likely to raise interest rates, helping the greenback when that time comes. In a look at our upcoming releases, tonight we get trade balance data from both New Zealand and Japan, while Australia posts its leading index as well as private capital expenditures. Overnight, Switzerland posts its employment level, and the UK releases a measure of retail sales, and Germany releases its preliminary version of its consumer price index. Tomorrow in the US, we get the weekly jobless claims data as well as the second version of GDP growth. From Canada, we get a measure of corporate profits. And that will wrap up this version of the Daily Market Recap. For more news, videos, and analysis, please visit our site, cmsfx.com. I want to thank you for watching and wish you good trading.